QDTE looks like just another dividend ETF until you actually run the numbers. Most investors have no idea what QDTE is really paying out. And once you see this, you'll understand why it's been quietly exploding. Today, I'm breaking down the real income, the hidden risk, and how much a serious position in QDTE would actually earn. And trust me, nobody is showing this part. Welcome back to Simply Money. The Roundhill Innovation 100 Zero DTE Covered Call Strategy ETF, or QDTE. I know that's a mouthful. It's designed primarily to generate current income for investors. Its secondary objective is to provide exposure to capital appreciation. What makes QDTE unique is its use of synthetic covered call strategy centered on 0 days to expiration, or zero DTE call options. The premiums collected from selling these very short-dated options are intended to be passed on to the shareholders as weekly distributions. Many investors are drawn to QDTE for its high weekly income, which historically has produced unusually large dividend yields relative to the traditional equity ETFs. But the income can include return of capital, and the strategy's complexity and risk mean it's more suitable for investors who understand option-based income strategies and the trade-offs between yield and total return. So let's dive into the spreadsheet. All right, a quick recap for those who have not watched the channel before. In this series, what I'm doing is I'm taking one fund, and this one is QDTE, and I'm doing a hypothetical. What if I took my entire income portfolio, which you've seen on the channel where I have it diversified in many different places, but if I took it all, the income portion, and I threw it in to one of these funds, what would it look like if I did a drip, 50% drip, or zero drip, and then looking at what percentage of drip do I need to maintain the exact balance that I began with and be able to collect some income. We'll look at all four of those scenarios, starting with the 100% drip. This fund came into inception on March 27, 2024. The price at the time was $45.98. With the $525,000 purchase, that would have given us 11,418 shares of QDTE. If we look down here, we have the dates and the stock price at the time. Starting out at $45.98, we can come down to the bottom here and we can see that it has slowly declined. Over the last 20 months, it has dropped negative 23.23%. It has had a decline, but not a very rapid one for those who have followed other funds like Alti, where the NAV has just really dropped fast. With this, it has not dropped that fast, but it has dropped and it doesn't recover as quickly. So eventually this is going to have to make some adjustments, just like a lot of high yielding funds do. We can also look at the dividend payment or the distribution. Back in March, the first distribution was 36 cents, and you can see all of the distributions each week because this is a weekly payer, which for income investors is usually very enticing. You combine high yield with high frequency payments, and the income investors like that. It has a lot of options, a lot of flexibility for different things you can do with it. As we look down that column C, you can see that the dividend distribution has fluctuated anywhere from the upper 30 cents down here as low as 14 cents. Looks like the lowest one we had for a while. And then as we come all the way down to the bottom, you can see that there's been some others that have been lower, but it is maintained in that. And so for the 20 months, the weekly average has been 26 cents, almost 27 cents. It has been pretty consistent in the sense of it hasn't had huge fluctuations, but it has gone anywhere from about 14 to 38 cents on a regular basis and continues to pay that each week. Now, when we look at doing the full drip, meaning that everything that comes in, we just buy more shares. We started out with 11,418 shares. We got this first distribution of $4,000. We were able to buy more shares. Now our share quantity is up to 11,508. Each week, you can see the fluctuation here. We did have a 9-cent distribution here in early April. You can see the big drop there from 4,000, 3,700 down to 1,000. But then it goes back up to 3,000. It's been pretty steady. But now you're going to see these are going to grow in comparison to the amount of the distribution because you're accumulating so many more shares each week. And we're going to come down here. We just follow that all the way down. You can see here in December of last year, some big payments with 87 and 80 cent distributions. You had back-to-back weeks where you got $12,000 in those 2 weeks. So that's in 2 weeks there, you basically got $25,000 in distributions. Nice way to end the year, in my opinion. That was a nice extra payout they did there. When we come down, you can see that it's averaging $3,000-$4,000. And as we get down here, even though these distributions are a little bit lower, even look at here, 19, almost 20 cent distribution, still paid right at $4,000 because now look, you're up 20,123 shares from this 11,418. You've accumulated so many more shares that even with a slightly lower distribution, you're getting these weekly payments. After 20 months, you're averaging here 4,600, 4,800, 8,000, 4,200. You're averaging a nice weekly distribution because you've accumulated 9,698 more shares from this position by doing a full drip. And let's say we always use this scenario. Let's say you did the full drip for a while to accumulate shares and your portfolio balance, and then you turn that off. Now, when you go to the zero drip or some percentage of the drip, instead of dealing with 11,000 shares, you're dealing with 21,000 shares. You've gained almost 10,000 shares that you're going to get this distribution on. But it's a nice way prior to beginning to need that income to roll in to something like this, allow it to accumulate, build up your share position, and then start drawing down. Now, we can see here that by just dripping and adding more shares, even though the share price is down about $10, the value of the portfolio is up $220,000 because you're multiplying this $35 per share times almost 10,000 more shares. It's a great way to really build up your portfolio balance. And see in that 20 months, it has grown the balance by almost 42%. Now, when we go back up here to the 50% drip, we have this amount which is being reinvested, and you have this amount that you are using. So you're collecting this amount for income, but you're also buying this amount for more shares. And that shows here how many shares you're accumulating. And so this is going to grow slower than over here because you're only dripping 50% of the distribution, but it's still going to grow because you're still adding shares. We'll just come down to the bottom here and we'll look at where we're at the 50%. At the 50% drip, you have received $160,528 in 20 months, and you have invested that much more back into the fund. You have accumulated just over 4,000 more shares, and you have been able to receive $160,000 in income. A really nice payday and accumulating more shares, which puts your portfolio balance just about where it started, just slightly up by 4.47%. It's a nice way to keep up with inflation, building up this position a little bit and making sure this continues to grow for you. Now, as we look at the zero drip, you're taking the full income and you're using it. With that, the share quantity stays the same throughout the entire scenario here because you're not buying more, you're just collecting those distributions. I want you to note here, with zero drip on and you're taking the full distribution, you can see these distributions here, 4,000, other than that one low one here. They're quite a bit lower. You can notice here these big distributions that were made in December of 24 are still rather significant in this zero drip. You would have received to use for income $19,000 that in those 2 weeks. So December would have been a really nice month on your income if you were just taking this out 100%. As we get to the bottom, that the distributions are averaging here. I mean, you're still getting a nice payday, about $10,000, $11,000 a month as you add the weekly payments up, but you haven't accumulated any more shares. And because of this price share depreciation here, your portfolio is down 23.23%. You're down to $403,000. If this was your full portfolio and you went all in on something, which I do not recommend, this is not financial advice. This is for entertainment, informational purposes only. I do not recommend going all in on any fund. I always say that in these scenarios just so people don't think I'm promoting to go all in on any fund. This is just to show you the power of these and what they could do if maybe you put a portion of your portfolio. Maybe with this portfolio, you put $25,000 or $50,000 in there and get a portion of this. So you did $50,000, you'd get a tenth of that. Instead of receiving $277,000 in those 20 months, you would have received $27,000. It's still a nice, healthy income off of a $50,000 investment. But in this scenario, this would have been gone from 50,000 down to about 40,000, give or take. You would have been down 23% based off doing no drip. As we go down here, you can see that with the full drip on, this is how much your total return has been. That is your price appreciation. That is what is in your portfolio. You haven't touched it. It has grown almost 42%. With 50% drip, you received $160,000 of dividends, and you had the $23,000 of appreciation. You've received a total return of 35%, a very healthy return. Now, with the zero drip, you've received the $277,000 in distributions, but you have to subtract the $122,000 here that your portfolio balance is down. So your total return is $155,000 or 30%. Again, over 20 months, a 30% return is very healthy. I would be happy with that every 20 months with any of my funds. This gives you a good picture of what it looks like with 100% drip, 50% drip, and zero drip. Now, with this one, there's a big disparity. Some of our funds we've looked at, even with zero drip, you're still maintaining or growing your balance, which is really nice. Now, with this one, because it's a higher yield, you have to look at, okay, now I want to maintain my balance, but I still want to draw some income. Where can I be at? That's why we have this flexible chart over here. And if you'd like a copy of this, this is the QDTE all-in spreadsheet available on Buy Me a Coffee, and the link in the description. Feel free to grab one. You can put in the amount that you have and the date you want to start, as well as the percentage you want to drip to see what your income and balance would be through the back testing of that. So if those of you that like playing around with that, those are available for you. But what we came up with on this is 43% drip, 50% income would bring us right to where we want to be, where after 20 months, our balance is pretty much the same, and we've received $180,000 in income. That's approximately $9,000 a month that you have received on average, which is very healthy off of a $525,000 portfolio, and you've maintained the balance. Now, I'm not saying that this is what I would do, because this is just over a very short period of 20 months. If we had a prolonged downturn market, this income would be lower. You would see this dropping. You'd have to take a smaller amount, so you'd have to have a larger drip amount. Let's just say you went and you had to do 60% drip. You can put that in and it shifts everything for you. Now with these numbers, how it's been, you would have grown your portfolio by $11,000 and you still would have got $132,000 in income. This allows you to play with it, see the different scenarios, how this would have worked, how it would have performed, back testing it from its inception. What are your thoughts on QDTE? Do you own QDTE? Have you thought about owning it? Does this type of scenario help you understand how these funds work and what you would do with them and how you could use them to help generate some income? Again, I use the full portfolio in these all-in scenarios, but even if you took a portion of your portfolio and put it in funds like QDTE or NVYY or QQQI, and then you generate that income, it's a nice way to help supplement your income, and you can see where you can maintain that balance. So that's it for today. Thank you for joining me. Don't forget to hit that like and subscribe button. It does help the channel out. And leave your comments and questions and thoughts and funds that you'd like to see scenarios run on. And we will see you next time on Simply Money.